Hello and welcome to our fourth quarter market update webinar. My name is Anthony Williams and I'm an investment advisor representative with Mosaic Financial Associates. We are honored to be joined by Cetera's Chief Investment Officer and Director of Research, Gene Goldman, today to discuss the current state of the market. But before we introduce Gene, I would like to go over some upcoming events that we have going on in the back end of this year. Our fourth quarter charitable initiative, Wild Wealth's annual Toys for Tots Toy Drive, benefiting the Marine Toys for Tots program. We are delighted to announce that our nonprofit, Wild for Arizona, will be focusing our efforts on the Marine Toys for Tots program throughout the fourth quarter of 2022. We have partnered with the Marines Toys for Tots Foundation to collect new unwrapped toys for our Valley youth. Please visit our events page on our website to learn how you can donate and keep an eye out for future email communications. We also are excited to announce that we have two educational events coming up in October and in November. On the 26th of October, which is a Wednesday, we have a Managing Your Lifestyle webinar. And then on the 30th of November, which is a Wednesday, Understanding Life Insurance webinar. And you can learn more about these webinars by visiting our events page on our website.
Hello, everyone. I'm Gene Goldman. I'm the Cetera Financial Chief Investment Officer. Welcome to my presentation, Navigating the Markets, Navigating this Bear Market. It's a market update. Before I jump in, let me talk to you about where we are right now. And, unfortunately, we are in a bear market. The S&P 500 is down around 24% this year. It's been pretty ugly. What I'll do is, before I dive into the causes of what's causing this bear market and give you our prognosis, I want to put everything into perspective about what's taking place. So if you look at this slide, since World War II, we've had 13 prior bear markets, and the average decline is down 32%. We grabbed data from a firm called Bespoke, and they took this data back through the Great Depression. And in terms of days, we are in the 12th longest bear market, about 210 days. 16 have been shorter. But more importantly, we've been about, this bear market is about the sixth smallest in terms of a market decline. So why did stocks sell off so much? Well, the key point is that since late August, the Fed has become more hawkish. So hawkish means they want to raise rates more and faster than the market had hoped. So again, the Fed's becoming very hawkish. So with this as a backdrop, let's talk about our three investment themes. And our three themes, if you take them all together and you see them right here, inflation is still very high. But unfortunately, the Fed is willing to push us into a recession. And this is what we call a policy error. The good news is that if we have a recession, we do expect it to be mild. And I'll talk about some reasons behind that. And then volatility and market weakness are likely to be with us for a long time, especially as we as investors try to gauge how deep a potential economic recession can be and whether this turns into an earnings recession. So I'll talk about these and I'll cover some positives throughout all this noise. So let me dive into the first theme. So the first theme is basically the risk of a policy error or a potential recession created by the Fed. So we talked about this before, but let's say the Federal Reserve, they have what's called a dual mandate. And a dual mandate is that they want to make sure that we all have jobs, and they also want to make sure that prices and inflation stays manageable. That's their dual mandate, and it's two different goals. And with inflation so high, they're not really doing a great job in terms of addressing inflation. So this is why, with elevated inflation and the fact that the Fed did not address this soon enough, created a very hawkish Fed. And hawkish, again, means very aggressive. And if you take a step back, what the Fed does is that to slow down economic growth or to slow down inflation, they raise interest rates. If they raise interest rates, mortgage rates, borrowing costs go higher, and this theoretically slows the economy down. If the economy is going too slow, they cut interest rates, it pushes down mortgage rates, and this theoretically increases the speed of the economy. So that's in a nutshell what the Fed does. So this year, the Fed has raised interest rates 5 times, to raise rates of 3%. And if you look at the sort of the futures market, and this is the futures of what the market thinks the Fed will do on a go-forward basis, the market expects the Fed to raise rates at its next meeting by 0.75%, and its meeting in December by 0.5%. That's another 1.25%. If you think about the speed about that, if you look at this slide, the last time the Fed raised rates to get to this level, it took them 3 years. This year has taken them about 5 or 6 months. And if you look at what's called the dot plot, and the dot plot is a document the Fed produces once a quarter where they give you estimates of what they're thinking where interest rates and inflation are going. This dot plot suggests that the Fed will raise rates all the way to 4.4% by the end of this year, and then 4.6% by the end of next year. So the Fed is here to raise rates for some time. But there are ramifications on the economy that we need to be very focused on. You think about housing, you think about manufacturing, you think about the world of the economy and investing. If the economy is doing really well, what happens is that companies sell more TVs, more cars, more widgets. They sell more stuff, they generate more earnings. If they generate more earnings, this drives the stock market higher. People are attracted to the shares of those companies. So that's why investors and companies like better data coming in better than expectations. They like positive economic surprises. If you look at this slide here, this slide plots it plots economic surprises. When the line moves higher, that means data is coming in better than expected. When the line moves lower, data is coming in below expectations. And you see on the far right-hand side, the line fell sharply. It's bounced back a little bit. The sharp fall shows that the Fed raising interest rates is really impacting the entire economy. Things are starting to slow down, like housing, like manufacturing, as I mentioned before. You see a little bit of a bounce back on the right. I wouldn't worry about that. That's just basically inflation and labor data coming in better than expected. So the key thing about the Fed is that the Fed has not yet bent inflation. They want to lower, they want to roll it over. We are in an environment, unfortunately or unfortunately, it's called a good news is bad news environment. Any good news about the economy is met with bad response by the market. So for example, let's say the economy, let's say there's a report that says employment comes in better than expected, more jobs, which sounds like great news. It is good news. But this increases the fact that the Fed is more confident to raise rates and they won't break something in the economy. So again, this is what we are focusing on. So this risk is our first theme. This sharp rise in rates triggers some type of financial instability, some big type of concern. It could trigger a deep recession. We do think a possible recession is maybe in the first half of next year. Again, maybe. But the good news is that if we do have a recession, we do think it's going to be mild. And that's our second theme. So the first theme is that the Fed breaks something, it creates a recession. The second theme is that if there is a recession, we have 3 reasons why we believe this recession will be very mild. First reason is employment. The employment picture is very strong. We have a near record low unemployment rate. We have jobless claims coming down. We have the number of jobs out there right now. Get this, there's about 4 million more jobs out there than people looking for jobs. There are so many jobs out there. Even people that don't want jobs can find jobs. There's so many jobs out there. Because of the strength of this labor market, this is going to put a good foundation in terms of our economy in helping keep a potential recession mild. The second reason, I know this is going to surprise you, but the housing market is still pretty strong. There's a good foundation, and we learned a lot of lessons from 2007 and 2008. So remember in 2007 and 2008, we had the big housing run up, and then we had the great financial crisis. So we're watching housing very carefully. It's such an important component of our economy. It's the most interest rate sensitive part of our economy, with mortgage rates around 7%, with open houses increasing, with sales falling. Housing is under pressure. I saw a stat from Realtor.com that said 20% of sellers during the month of August actually dropped their asking price. Back in August of 2021, it was 11%. So housing is being affected. But the good news is that because of this strong housing foundation, housing will be impacted, but we see it being more normalized. And there's many reasons why. Inventories for housing are very low. Second of all, if you look at this chart shows owners' equity at homes, homeowners' equity. And households have extremely high equity relative to home value. We're looking at levels that we haven't seen since the 1980s. So this provides a good cushion if home prices fall, which they probably will, as if we hit a recession, home prices will fall, but we have a good cushion. Third of all, the debt, especially mortgage debt relative to income, is still very low. And this is really helping our overall economy. Here's an example. If you look at some statistics called loans rolling from being current, so people are making their payments, to 30 days past due, this actually decreased by 50,000 in August. And we're still about 23% below pre-pandemic levels. So this low debt really helps people continue to make mortgage payments. And then the other point is that product risk. it has dropped dramatically. No more are we talking about balloon payments, variable rate loans, teaser rates, or other mortgage tricks. Those don't exist today as much. So we have much tighter standards around the post-Great Financial Crisis. Roughly about 90% of U.S. mortgage loans are either a 15-year or a 30-year fix, and probably at very low rates. So the result is that mortgage delinquencies, people unable to pay their mortgages, are very low. The national delinquency rate for mortgages fell by 0.10%, so 0.1% in August, to 2.79%. That's just 0.04% off of the record set in May. It's a lot of numbers, but all this means is that very low delinquency. Yes, this will reverse. We will see pressure on prices of homes. But, there's still going to be, we're really, really strong foundation. You look at foreclosures, initiated by banks, increased by 15% in August, but they're still about 44% below pre-pandemic levels. So the key point about housing is clearly in the crosshairs of the Fed. They want to slow demand so we don't purchase as much home goods, so we start to reduce inflation. The good news is that we don't think this will cause any type of deep recession, given the strong foundation and tighter lending standards. House prices will fall a bit, but only partially give back those pandemic gains. Third reason why, if we do have a recession, we think it's going to be mild, is a concept called a rolling recession. So we don't anticipate a very deep recession that affects the entire economy at once, but it's a rolling recession that kind of rolls through the economy, and we won't see a significant contraction in economic output or GDP. So if you look at our economy today, housing, autos, manufacturing are already in some type of a pseudo recession. Consumer spending is still pretty strong, it's still pretty okay. We do believe that as it rolls through housing and autos and manufacturing, it's going to hit retail and consumer a little bit late, like you and I. But and part of it is because we start spending down our savings, people start spending less. But the good news is that it's not all going to affect the economy at once. It's a manageable recession if we have one. You look at this chart here, and this chart plots two data points. It plots an index for manufacturing and an index for services. I'm not going to get into the nitty-gritty here, but basically, if the index is above 50, it's expansionary. Below 50 is contractionary. And you see here on this line, the line going down further, that's manufacturing. Manufacturing is struggling. It's in a recession. But the light blue line, services, are still pretty strong. So services are down a bit, but still very strong. Nothing dire is screaming out here. So a recession is maybe likely. I mean, I can't really definitively say that we'll have a recession, but a recession is likely, okay? And the Fed is really doing its best to trigger one, and they want to trigger one because they want to bend inflation. They want to slow inflation. One question we get is, are we in a recession? And maybe we are, but not officially. You look at this slide. This slide shows 6 indicators that this group called the National Bureau of Economic Research, and they're the group that decides we are in an official recession. Of the indicators that they follow, 5 are positive. The only one that's not positive is manufacturing. We know manufacturing is in a recession, but other parts of our economy are pretty strong. Consumer, income, spending. Most likely, if we do have a recession, I hate to say this, but it's most likely going to be the first half of next year. Again, if we have one. And why first half of next year? Because that's about a year after the Fed started to raise interest rates. It takes about a year to 18 months to affect our economy. And the issues we're seeing outside the US will eventually affect our economy, like the weakness in the currency in Europe, the high inflation outside, the unfortunate events in Ukraine. All this is going to affect us. And we do think if we have a recession, it's going to be the first half of next year. The good news, and again, this is the good news, our second theme is that even if we have a recession, it will be, in our opinion, very mild. Third theme is volatility and market weakness is going to be with us for some time. So market volatility is here for a long time because investors were trying to figure out, will this recession be a deep recession? How bad will it be? Will it become an earnings recession where companies' earnings start to slow down? You see here, there's many ways to measure volatility, but volatility here is just simply how many days does the stock market move up or down 2%? And you see here on the far right-hand side, it has moved dramatically. So the markets are really reading into all these data points, understanding what the Fed is doing and saying, okay, let's see what's going on. Where are we headed from an economic standpoint? So let's dive into some of this volatility and talk about some potential positives. So we did see stocks rally recently. They were selling off for a while and they had a big rally. what drove some of this is that there were some signs out of Washington, out of the Fed, that maybe the Fed may not raise rates as much. So we saw a little bit of that news, but we also saw what's called negative sentiment. So sentiment is this perception that investors say, you know what, the stock market is bad, it's going down, I'm so scared. When sentiment is so bad, it's actually called like a contrarian indicator. That means everyone is so anti-stocks, they tend to do really well. If you look at this chart, there's two lines. The purple line going up is the S&P 500, the market going higher. The blue line at the bottom, the zigzag up and down line, that's sentiment. And that's basically optimistic people, investors, subtracting out pessimistic investors. And you see the line has come down low. We are at levels in terms of sentiment not seen since the COVID recession of 2020, just those terrible points. So this is part of the reason why stocks have rallied recently to take advantage of this negative sentiment. Another thing we look at for sentiment is what's called market breadth. This is a busy chart, but all this says is that there's so few stocks doing really well. When that's so much pessimism, that tends to be a good opportunity when stocks could rally going forward. And you see it on the bottom, whenever stocks have fallen to these levels, like during a deep recession, during concerns about a sharp recession, that they've fallen down to very low levels like this. Again, that's just another sign of extreme pessimism. So we've had stocks fall off. As I mentioned, stocks were down about 24% through year to date. The result of this sell-off is that valuations are much more attractive than they have been in a while. So for me as a market strategist, I look at what's called valuation. And a simple valuation is a price-earnings ratio. It's the price of the stock market divided by the stock market's earnings. It's called the PE ratio. At the beginning of the year, it was around 21 or 22. It's pretty expensive. Today, it's down to about 15.9, maybe about 16, very low. It's come down significantly. Low valuations are not a reason to buy a stock. There's other reasons. You have to look at fundamentals and maybe technicals and so on. But low valuations do offer you some protection. So the good news is that even though stocks have come down, valuations are much more attractive. So there's some wiggle room in terms of if the economy worsens or in terms of the data gets bad. We do believe, our expectations are that the stock market will be in this range bound for some time. And range bound just means kind of like this ziggy-zaggy for a while. But with that said, I'll talk about this and I'll talk about some of the reasons why we're a little bit positive that maybe the markets are just overreacting a bit. So you look at the bond market, and the bond market is that market that companies can borrow money in the stock market, issuing shares. They can also borrow money in the bond market, selling debt, selling bonds, and something that's called high yield spread. So high yield is basically a riskier bond, and it's basically an investment that it's still bonds, but you're taking higher risk because it's maybe a less of a quality company, or maybe it's just a little bit more of a risky investment. And because there's more risk, investors want more compensation. And so the spread between that riskier bond relative to a comparable US government bond is called a high yield spread. And it widens when things get bad, it narrows when things get good, when people feel confident about the economy. If you look at this slide, high yield spreads have widened a little bit, but nothing crazy. And the widening is basically stock market weakness. If you look back at other market dislocations like COVID, like the potential 2016 recession scare, 2008, the big bar on the far left-hand side, we're nowhere near those levels, nowhere near that at all. So the good news is that bond market is not saying there's lots of bad news out there. Another point, speaking of fixed income, we've been getting a lot of questions that say, you have asked, well, I keep hearing about UK pensions. I keep hearing about these companies that could go bankrupt, that could impact the entire financial market. Are we going to have another big dislocation, a big systematic crash in the financial system? And this comes up every once in a while. And there's three things I want you to think about. First of all, not every financial bankruptcy has triggered a recession. Remember the late 80s and early 90s with the S&L crisis and the collapse of Drexel Burnham? Well, the 91 recession that followed was very, very mild. Then remember those companies, WorldCom and Enron back in the early 2000s? They both went bankrupt, but the 2001 recession was fairly quick. Number two, banks are in better shape today than they were during the great financial crisis. You look at what's called Tier 1 capital ratio. This is basically it's a measure, it's a measurement of bank risk. And right now, tier one, or bank safety, excuse me, right now, tier one is at 13.6 for banks versus 10.1% before the great financial crisis. Banks are in better shape. They're also relying less on short-term funding. Today, about 4% of assets are short-term funding versus 21% back in 2008. Back then in 2008, volatile interest rates really impacted banks. And then loan to deposit ratios are at 0.6% today versus 1.1% in 2008. Overall, and I threw a lot of stats at you, banks are in better shape today than they were before. The third point is that household and corporate balance sheets are in great shape. Debt is low relative to income, and lending criteria has really tightened up. And I think this is probably the most important point. You know, the government does what's called stress tests, where they stress test banks and say, okay, in times of a recession, in times of an economic calamity, how will you survive that type of environment? And companies today actually have survived a real life stress test. That's the pandemic. So if a company could survive a pandemic where we had growth come to a standstill, where all these bad things happen to us and our economy, they can survive a mild recession. So the key point in all this is that the Fed, by being aggressive, by being hawkish, will keep raising rates. They're going to break something. Something is not going to go. The company is going to go bankrupt. Something bad will happen. But we don't see a big systematic danger that affects the entire financial system. So the Fed is really aggressive, as I mentioned, and they want to rein in inflation, because if inflation keeps going too high, then goods become too expensive, it slows down consumer spending. There's lots of other reasons why. But reining in inflation is so important to the stock market. And why is that the case? We see here, there's an inverse correlation between CPI, the Consumer Price Index, which is an inflation measure. And remember that PE ratio I talked about earlier? So every time PE ratio goes higher, that means stocks are getting more expensive. That means people are buying stocks. Inflation has come down. There's an inverse correlation. If the Fed is successful, this is good for the markets, because then CPI will start to come down, inflation start to roll over, and then valuations should start to improve. Very positive for the markets. This is why the Fed is so focused on this inflation. Yes, they want to help reduce inflation expectations, but it's also good for the stock market, lower inflation. So the Fed is fighting inflation. Remember, they're raising interest rates. When they raise interest rates, this slows down economic demand, less inflation pressure. But even beyond the Fed fighting inflation, we're also seeing signs of potential disinflation. You look at this slide. This slide shows inventories at retailers. And basically, inventories divided by retailers. When the line moves higher, inventories are accelerating at a faster rate. We do believe that inventories are at such a bloated level. This puts downward pressure on future prices. Retailers are going to have to aggressively cut prices. So you're thinking about buying things for Halloween, for Thanksgiving, for Christmas, expect a lot of sales, because retailers have a ton of bloated inventory, and they're going to start cutting prices to get this off of their store shelves. So something we've talked about before is rent. We all know rent is high. You hear this in the paper, you hear this on TV. CPI rent is very, very high. But if you think about rent in terms of like what it is today versus the future of rent. Today, rent is high. It's definitely high, and people are locked into rent agreements. But you think about the future of rent, is what's called asking rent. And this is what landlords are posting apartments, posting things onto websites to say, here's our asking rent. And it's almost like the futures market of rent. And you see here, these purple bars that go up and then going down, these are starting to roll over pretty quickly. Asking rent, things that landlords are posting on websites to rent out their properties, are starting to slow pretty quickly. That's good news. That's very disinflationary. Again, this will help the Fed. And then we're also seeing goods inflation. So we talked about goods inflation. So TVs and cars are starting to slow down. The one thing we're watching carefully is what's called services inflation. Services inflation is very stubborn. That's like inflation at restaurants, at bars, and there's really no real signs that it's actually bending over. But we do believe that the Fed is going to be okay with service inflation slowing last. You think about service employees, people that work at restaurants and bars, they tend to have a higher percent of the lower income cohort. So the Fed is okay, in our opinion, to wait and say, okay, you know what? We will bend service inflation last. We will let lower income households benefit higher service inflation. So you look at this chart shows two lines. purple line and the blue line. The blue line shows services inflation is still pretty high. Goods inflation is starting to roll over. Again, we do believe that services inflation will be stubborn for some time, but the Fed is okay with that because, again, it helps lower income households. So the Fed continues to talk about the labor market, that the strong labor market will either protect the economy in terms of rate hikes or that they need to bend the labor market to slow inflation. And just recently, we saw a report that this is starting to play out a bit. I know we've seen a bunch of different economic and employment reports, but there's a report that came out called the JOLTS report. This is basically, JOLTS means like, number of jobs that are open. There's other stats, but number of jobs that are open. And we're seeing a sharp hit in job openings. You look at this line on the top, job openings have started to fall. That means companies are saying, we have fewer job openings. This is good for slowing inflation. And if you look at the bottom of this chart, you're starting to see services jobs are starting to be hit. Goods jobs, manufacturing have been hit for a while. Services jobs are starting to take a hit. And we believe this will flow into services inflation. Slower inflation helps the Fed not raise rates as much, and it's good news on a go-forward basis. So here we are, today, what do we look at for the markets on a go-forward basis? What can help drive the markets? And there's two events we're watching carefully. Number one, will a potential economic recession turn into an earnings recession? Earnings recession is when earnings fall dramatically, fall lower. And if you look at earnings estimates, and these are what a bunch of analysts out there say, okay, we think the stock market is going to earn, or the companies in the stock market are going to earn this amount over the next few years. Analysts expect earnings to rise about 7 to 9% each over the next couple of years. That's a little too optimistic, especially we have a slowing economy and earnings are really above pre-pandemic trends. We do believe that earnings will be revised lower, but you don't expect some type of deep or long recession. There's a chance that earnings might not fall too far because if we do have a mild recession, that's good news for the economy. The other thing we're watching carefully is the Fed. And I know I've talked about the Fed so many times, but if you look at this chart, the purple bar shows what the Fed is expecting to raise rates. This is what they came out and said. The light blue bar is what the markets expect the Fed to raise rates. You see the markets expect the Fed to raise rates a little bit less. We're on the same page. We don't believe that the Fed, we think the Fed will raise rates less than they anticipate. We'll get some news about this in the next couple of weeks, especially the meeting minutes. We'll get some CPI reports, but we do think with the Fed really addressing inflation, with the number of rate hikes, all this other data, the strong dollar, I can rattle off reasons and reasons. We do think the Fed may raise rates less than the market anticipates. So we're watching Fed speak very, very, very carefully. And Fed speak is when Fed governors come out and talk about what's going on in terms of the economy, about raising rates. And one thing that we get a lot of questions on is, what's the Fed going to do? And if you look at this slide, the slide shows something that we produce that your advisors have access to. They share it with you. It's called our Fed Monitor. It takes key economic data that the Fed looks at and gives you an idea. Is the Fed going to be aggressive or are they going to be conservative? And so we take all this data, we squeeze it together, and we give you like a dial to say, okay, the Fed is here. They should be more aggressive or they should be less aggressive. Take a look at this. It's a client-proof piece, and talk to your advisor about this. It's a great piece. And you see here won an award in terms of intellectual analysis. So please take a look at this. So what do we do on a go-forward basis? So our three themes are: the Fed is raising rates, likely to break something, create a recession. Number two, that we have a recession, if we have a recession, I'm going to stress if, we do believe the recession will be mild. And number three, market volatility is with us for a very long time. And the good news is that we've seen, because of this market volatility, we've seen lower valuations. Question we get from a lot of you is, well, okay, that's great on your themes. Where's the stock market going? And you got good news and bad news. The good news, if we have a recession, it's going to be mild. That's our opinion, okay? The bad news is that the stock market could still struggle in that type of environment. So if you go back to the 2001 recession, it was a very mild recession. And we think it's very similar to this potential recession. So back in 2001, you had the dot-com bubble run up beforehand, where earnings were revised sharply higher. Analysts were talking about the number of clicks and all this other stuff, the number of clicks, the number of data points, all that stuff they looked at back in the dot-com bubble. And this drove earnings higher. Then we had the 2001 recession, and then earnings were cut dramatically lower afterwards, even though the recession was mild. we are a little concerned that this could be a very similar play where earnings were dramatically raised because of work from home, because people are buying more stuff and buying more bikes and cars and TVs and stuff. And despite us having a potential mild recession, earnings estimates could be ratcheted down even more. If you look at analyst estimates for earnings on a go-forward basis, S&P for end of this year, earnings are expected to be around $223. For next year, on $241. Our expectation is that there's going to be a really wide range, and the question we get is, where do we see stocks going? And I think our base case is around 3,900 for the S&P 500, and right now it's around 36 and change. What's the worst case scenario? The worst case scenario, we envision a scenario where earnings get cut and there's downward pressure, and stocks would fall through the first half of next year. That potential downside, you're probably looking at maybe 3,200 to 3,300 on the S&P. So maybe a fall of another 10% or so from these levels. So I know it sounds ugly, but keep in mind, though, we do think the mild recession is going to appear, though, if we have a recession. Also, the market is a very forward-looking mechanism. Eventually, what they say is that the market says, okay, we're in a recession, let's start the price in the recovery, and stocks surge and dramatically move pretty quickly. So as I kind of wind down, what do you do? How do you take advantage of this environment? And there's two things, and I continue to believe this. Number one, be diversified. Have exposure to different parts of the market, not just growth stocks, not just value stocks. Have exposure to different parts of the market based on your long-term investment objective. Number two is, how do you determine what is the best portfolio, the best diversification for your long-term objective? That's being in front of your advisor, getting them, sitting in front of them, talking to them, keeping them updated in terms of your financial position, in terms of your objectives, because they need to make sure your portfolio is not too aggressive or not too conservative. We are in a volatile ride right now that may continue for some time. Given this, stay in constant contact with your advisor. So very, very important. Thank you for listening, and I appreciate that, and have a great day.